Hello, everybody, and welcome to the Market Standard with myself, Dineo Zamela, and Simon Brown. I hope and trust everybody's well. Before we continue, I just want to make sure that everyone can hear me. So if you can hear me, could you please lift your digital hand? It'll be the hand icon next to your name. All right, I see a few hands. Thank you, Simon. Good morning. Welcome to day 172, of
Two, I think.
lockdown. I don't know
Morning dinner.
anymore.
I think it's one set that that prisoner board which one keeps. So you cross off the.
Be that. I mean, I just want the borders to open. I'm not sure where I'm gonna go, but I'd like to go somewhere. You. But yeah, so shall we kick off looking at the US as we usually do? And obviously last week, market volatility articles around that. And obviously every time there's like any sudden massive moves in the market, the bears come up to play.
Of September. 2 weeks ago. So what's happening? I mean, the U.S. futures are pointing positive. The Dow and the S&P over since worst week we had since. Thing to panic about. It's hard making profit. I mean, it's not like the .com when the big constituents, frankly, weren't even really doing sales. Your Netflix, your Alphabet. Apple, etc., they're making huge amounts of money. Absolutely. Amazon, all the rest. They're making the profits. That said, valuations are immensely stressed. Markets are at all-time highs. The earnings have come through. Not bad, all things considered, and some of them stronger than others, and very much a sort of a K-shaped recovery. On the one side, you've got the heavy tech going to start coming to the party. Stuff to worry about. There certainly is space for caution, but at this point, not panic. And even a bear market would take us down to about 9.5, which includes a pandemic and one of the most aggressive and fastest sell-offs that we've ever seen in stock markets. But we certainly are seeing massively increased volatility, and that was spiking. And it is a caution to folks that nothing goes up forever. Good idea.
Seeing, and I guess the thing has calmed people down, and we'll have a slightly more normal
Normal,
week
yes, in
this week.
2020. Yeah, and I think this week is going to be important to your point, Deneo. And if we look at volumes, volumes didn't massively spike in the last week. The profits, nothing fundamentally wrong with that.
Louis Vuitton was, made a big hoo-ha about buying Tiffany, and now basically the CEO Bernard against them. Quite quite an interesting turn of events. The deal worth about 16.2 billion US dollars, so a very, very big deal. And just this change of heart is a bit shocking, I think.
That's nothing new. That's also hardly Tiffany's fault. Collapse, and that then triggers potential clauses. Executives will come this, but certainly. I got to say, I would have thought a lot more. I would have thought a lot more deals would be a few major global and a couple local deals not happening.
We did say that, it is a bit surprising, or we didn't expect as much M&A activity, but it's been going on, and that has been very fascinating, I think, to sort of see that, despite everything, people are still going on, acquisitions are happening, sales are happening, and it's almost business as usual, but it's not really.
And having a look at the LVMH share price, the market liked the idea of a delayed deal. They pushed that price a little bit higher on the news.
Definitely. And we didn't have it in our notes, but because we touched on it last week, and I thought maybe acquire TikTok US.
Saying that nope, they the algorithm, not directly, but permission of the Chinese government. But Oracle was one of the bidders, but I really thought it was more aligned, sort of a Microsoft Walmart that made more sense. Oracle, of course, they've got cloud storage. TikTok, a huge user of the cloud storage. The initial, and this isn't actually a sale. As I said, it's more of a partnership where I suppose the maybe the data sits within American soil. What the American president was looking for, time will tell. There's of course Larry Ellison. Oracle is a big Trump supporter, so maybe, which is what one I think would have some degree messy. I mean, even the Microsoft Walmart deal was only looking at buying certain markets that TikTok operated in, not.
It's going to be quite interesting to get that direction or that guidance from the presidency, and obviously with the hopes that this isn't sort of like an election-related play, with that coming up like eventually done, will hinge on what happens in November.
Yeah, exactly.
It's a mess. And the EU and the UK just cannot seem to travel. That just seems they can't agree on a deal that works for both sides. The UK threatening, well, rather, Boris threatening to just sort of leave with no deal, which obviously is the not desired, where the motor manufacturing industry said they're looking at 100 billion pounds of losses if there's no deal Brexit.
Yeah, and the motor industry, and that's a great example because what we've seen, and in fact what this pandemic has shown up in many ways, but certainly what we've seen, the motor industry move to very much a just-in-time sort of supply chain. In other words, you've got enough bolts to make the next, I don't know, 100 vehicles, but that's fine because when you're making the 98th vehicle, another truckload of bolts will arrive for the next 100, and that requires a seamless moving through the ports because a lot of that has been. But if those truck expecting, this does just get very, very messy. Again, from a market perspective, the FTSE 100 doesn't mind because that's very much a global index. FTSE 250. Let's see if I can get that here. Nope, we don't get the FTSE 250. The FTSE 250 will have a much tougher time because that's very much more the local indices. There it is there. And this index really has been going pretty much nowhere, the 250, but it does show the complexity. The Brexit vote, which was now just over 16, so 4 years ago. The vote in itself was easy enough. The votes for Boris Johnson and his government was easy enough. The hard part is finding that deal, and particularly the Irish border. That is the sticking point. And there seems to be a lot of counter between the two. She said, he said, going back and between each other. The EU negotiators saying that Johnson and his government have negotiated in bad faith, and the UK government saying, but hang on, we need our autonomy. And I don't know. I mean, I very much suspect that there's a real chance here where ultimately there is a no deal. And then and that is solidly messy. I mean, in the background, the UK has gone off and done a trade deal with Japan, so they're getting their other trade deals up and working because, of course, they lose the protection of all the deals that they had via the EU. But a no deal with your biggest trading partner that literally sits across the channel, to me, can only be bad news. But it is something which absolutely is potentially on the table.
Yeah, definitely. And I think, it's again, it's going to be one of those, how does it sour or how does it improve, especially in that British region.
Yeah.
The UK is in quite a mess, and I think Brexit in and of itself is quite. When was it? 2 years ago, and that in 10 years' time we're still.
Chart. So Brexit was back mid 2016. The market's actually about almost 10% below that June 2016 level, which is when the Brexit vote actually happened. So that's the FTSE 100, which is very much more the international market. In large part, it just hasn't recovered since the sell-off of earlier this year.
Yep, definitely.
does quarter and then of course annual, and we'll talk about ours when we talk about the local markets in a bit. But the UK expecting some very, very strong bounce backs because of the base effect. In other words, the July is relative to June, and June was sort of a good pickup for them. The GDP contraction under the hard lockdown, we've spoken about this, was severe, but economies are opening and bouncing back. The UK has challenges with their 6p bad.
Yeah, having seen our numbers and starting to happening there, and sort of seeing, it'll be interesting to see how with the recovery.
Yeah, and what we are seeing, and France is a good example. The current numbers in France, case numbers, are worse than the initial spike, although fatalities are lower. Masks and avoiding sort of super spreader events.
And everyone's out and about. Certainly, I've seen a lot less mask wearing. Just watching Instagram stories. It'll be very interesting to see how people choose to actually conduct themselves, should there be need to impose restrictions of varying degrees with these lockdowns. Day of OPEC, because when it first started, this was set up to sort of rally against America's monopoly, so to speak, on oil. But now, OPEC and the US are getting along just fine.
Yeah, I mean, I was unaware that it was 60 years old. I mean, I suppose if I'd given it thought, I mean, OPEC so came into existence in 1960. In very much the Middle East oil nations sort of exerting their influence and their control over the world supply of oil, which they really then exerted in the 70s, and really put the U.S. economy into somewhat of a tailspin. I keep on reminding people that when Reagan came into power, when he took into the White House in rates in the mid-teens, etc. I mean, the OPEC, by simply turning off taps to a degree and pushing prices higher, had really found themselves in a massively powerful situation. We fast forward to now, and OPEC to a fair degree is, I would say, kind of lost their clout. They talk around OPEC plus, which includes Russia, which includes a couple of African nations, most notably Nigeria, in a sense of trying to control the world supply of oil. But the dynamics have fundamentally changed. None the least, if oil prices are low, as an economy, as an oil-producing economy, you've essentially got two options. You can cut production and try and hope that everyone else also cuts production and therefore pushes prices higher. Or you can just pump like crazy and say, look, if they're low, we're just going to try and pump more and get our revenue shortfall that way. And then, of course, hope everyone else doesn't do that as well. We did see that I thought negative interest rates would be the craziest thing I ever saw, is that the frackers in America turn on their fracking machines again. They're profitable at about that level. They're able to turn sort of easy, sort of puts a cap on the price to a degree. So oil seems very much at the moment, $60 oil. It means most of the oil producing nations are drilling profitably, and it means we're not paying the sort of $150 that we were just ahead of the 08-09 crisis. But OPEC, I think they probably wish they were still the organization they were of the 1970s, but their power has significantly waned in the decade subsequent to that.
Yep, and I think not only has it waned, I think in for lack of a better word, the spirit of collaboration, and I use that term very
Yes.
loosely. It does sometimes feel like Washington is still calling the shots when it comes to OPEC. So it'll be very interesting to see. I think where the organization goes and what it looks like a decade from now when we talk about 70 years of OPEC and the changes it's undergone. Because I with the current certainly members of the organization trying to be friendly with the American government, it's yielding very interesting results
Yeah, and just a quick
for the
point.
rest of us.
So America's predominantly drilling West Texas and the refine, but Brent in Texas, there's about a $3 difference at the moment. But broadly, the two oil city.
Moving on to SA, locally, and obviously the big news maker last week was Q2 GDP contracting by 51% or 16.4%, and there was a lot of debate about the 51% because it's quarter on quarter comparisons, year on year, it's annualized, it's not annualized, blah 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 blah. So Simon, please could you provide some clarity?
An incorrect number. It is correct. But in essence, for the 16.4% means that our economy was effectively 16.4% smaller in Q2 than it was in Q1. Less than a year, truthfully, doesn't make a heck lot of sense because the 51% kind of suggests that our economy would or could or will contract by literally half. But truthfully, that means we need to have 4 quarters. A situation where second quarter was, April, May, and June. It was, level 5 and 4 and a little bit of level 3 lockdown, sort of a month of each. We're not repeating it. In other words, we're not going to get 4 quarters in a row of minus 16.4%. So there was a lot of hype and excitement. It's just stats and numbers, and you can spin them either way. The fairer number is probably 16.4% down. It is an absolute horror number. It put us, well in the bottom sort of quarter of second quarter GDP numbers globally, as I mentioned earlier, and it was worse than I think most economists were expecting. Most were looking for a number perhaps closer to maybe minus, the worst side case, 12, maybe 13%. The only economist I know, and there were, there's obviously lots who I hadn't spoken to or seen. Davy Root was looking for a number that was sort of, around minus 15.5, maybe minus 16. The base effect does mean that the third quarter, which we are currently in right now, until the end of September, will bounce quite strongly and perhaps end up coming out at a plus 10%. The point is, what is our GDP going to look for 2020? And the consensus has been slipping. Currently, consensus from government and writing in the Sunday papers was saying he actually thinks it's going to be closer to 8. And I think he's right. I think we're probably set for maybe an 8 and 8.5. Even with the massive bounce back in Q3 and then a kind of a normalization in Q4, I'm not sure what more we can do. We can open our borders under level 1. That's probably the big thing that's left. Opening our borders will certainly help to a degree, but I still think there's going to be, there's certainly going to be pent-up demand. There certainly will be some travel in both directions, tourists into our economy, South Africans exiting out to other places, work, holiday, etc. But it's going to be, I think, a bit of a slow approved by our president, a month ago almost, and the pent-up demand has meant places have been absolutely packed. It's going to be a horror year for GDP in South Africa. Truthfully, it's going to be a horror year almost everywhere. The IMF is basically calling negative GDP for 2020 in pretty much every economy with one exception, and that exception being China. Other than China, we're going to have a 2020 negative GDP, and then a sort of a kind of a bounce in 2021, and then a sort of return back to the mean in 2022. Hopefully for us, we don't return to the mean, because our mean, unfortunately, has been floating at around 0.5 or maybe 1%. We need to get our economy growing at a base minimum. We just to keep the per capita income running, we need an economic growth of around 1.5. We need 3, 4, 6 or 7% growth under normal circumstances to really get our economy firing.
Yeah, and I think that's going to be the biggest challenge, Simon, certainly for the next 2 to 3 years. Trying to even just get to the pre-COVID levels, let alone, exceeding that and growing at that 3, 4, 5%.
Yeah,
so we definitely
Sorry, I jumped in there. I mean, the expectation is that the developed markets will get back to pre-COVID levels, maybe late 21, but probably 2022. For South Africa, it's looking to be more long on this podcast. And his words were they're seeing unprecedented levels of tender activity in the infrastructure space, and we're going it's construction work which helps employment and gets economic activity in the economy, and of course takes some pressure off Eskom, who kind of every time our economy starts to get going, butts heads with Eskom. So there are levers that can be pulled. Even just releasing spectrum would help in degrees for telcos and communication prices and the like. But then these need to happen and at this point.
Yeah, and I guess those are great indications, but still worth keeping an eye on.
Yeah, and still a long way to go.
Certainly. Moving to results now. So Firstrand sharing results. And, one of the things that certainly stood out for me, Simon, was, their impairment charges jumping from 10.5 billion in 2019 or full year 2018 to 2019. They've got a weird reporting, half-year reporting structure, but gone from 10.5 billion to 24.3 billion this year, and that's quite a massive jump. Not particularly surprising, but and I think despite this, still very well provisioned, and despite bad debts sort of shooting up, I think South African banks, and we've always said this, South African banks are always very well positioned in terms of those provisions. But certainly, I think also one of the more positive or better results that we've seen from the banks.
Agreed. And to your point, Danao, 24 billion rand. That is a staggering number. We've now had all four of the big banks report. Capitec will come out later this month. They're in August period end. With Firstrand, the key point, and you mentioned it, for them, June was a year end. For the other three big banks, June is a mid-year, so we're not quite apples with apples. They didn't declare a dividend, but they stated quite requested our banks to please not declare dividends. But it does look like Firstrand and Standard Bank will probably do December dividends, which we did. Not a bad set of numbers. And I think if we look at the four banks, to your point, Danao, I think the better two were Standard Bank and Firstrand. The two preferred banks. And again, what we saw is about going forward, and the banks are hugely cheap. I think the biggest risk to the banks did put extra provisioning onto their balance sheets. Obviously, is the local economy. Knockout numbers considering our economic growth. Nedbank, ABSA slightly better than half that of number. That is the banking index in of itself, still a third down. It's a weird index. It includes some property in there at the same time, which is odd. But banks have, I think, broadly actually weathered this better than I would have thought. If you had said to me, in January, we're going to have a pandemic, we're going to have minus 16% second quarter GDP, we're going to essentially shut our economy down for 2 months, our unemployment is probably going to hit 50% for those periods when Stats SA releases the data. I think the banks have come out looking okay in terms of their balance sheets, in terms of their profitability. It does just depend on the future. And Nedbank perhaps had the best line of all the results, which was quite simply that forecasting certainty is approaching zero. In other words, the ability to forecast over the next 6, 12, 24, 36 months is hardest than they've ever seen before. And that is probably the most telling point, notwithstanding the banks all offering great value. The question is, how does that value unwind and how long does it take?
Yeah, definitely. And it is a waiting game at this point in time, Simon. There's not much we can do. I think there's the kind of market we find ourselves in, and with these, do we go back to lockdown? Do things sort of work the way they've always worked? Factors into all of this, and to the conversation we were having earlier about, that lag in sort of catching up. That's surely going to start or will come through, or might not. We'll see the bank's results. And I think what's also been very fascinating is seeing how within the banks, the different divisions that have sort of been able to weather the storm. So, you've got your capital markets divisions sort of doing much better and seeing a lot more activity, trade activities, lots of funds just moving, and people doing things, hedging, etc. And that's obviously going to be great for revenue. Cycle of results. The thing to look out for would be either a reversal or a stabilization.
It does. It wants to break out. It hasn't, to my mind, yet broken out. It needs to get through that green candle there from early June, and then that green candle there from late July.
All right, cool. Now moving on to Shoprite, and I think we've spoken about Shoprite and I quite a bit, and I think at the start of the year, Shoprite was sort of kind of on shaky ground. I think previous results cycles have just the numbers just hadn't been doing what investors wanted them to do, but this latest set of results has been amazing. You've got headline profits up by 17%, dividend up because of the closures. But I think overall, certainly for South Africa, the numbers good set.
160 are my single biggest holding. I've always liked Shoprite. I've always considered them to be, frankly, one of the world's best food retailers. And their distribution centers have been astounding. Engelbrecht took over. Peter Engelbrecht, how would he? This year, the loss was a couple of continent break even. They're looking to exit. And when you were going into Lagos or wherever it was, and you wanted a shopping mall, which is what Shoprite wanted, finding developers was tough. So what you did to sweeten the deal for them was you signed long-term US dollar-based leases. In other words, you were paying in US dollar, which truthfully is a terrible idea, but at least you got, you'll have less of the currency impact on your leases at the same time. Operating margin up to almost 7%, 6.8% market share, 31% and change, and 5%. That adds another 30 odd billion to their 160 billion revenue. This is a powerhouse of a company. And I appreciate pandemic was only the last quarter of their full year. As you said, no liquor sales for that quarter. Food sales, distribution centers, best of breed globally. Oftentimes, when you look at a company in South Africa, and it's like, well, why not buy an offshore one? Why not go to WebTrader and buy the best globally? Well, in ShopRite, I think we have it right here on our doorstep, and I don't think we need to go and buy.
Definitely, and I think, Simon, of all the retailers, you have always loved ShopRite, and I think this is but it sort of makes sense given that we all decided to just start cooking and baking aspects, reprieve of a great set of results, their rand into the kitty and sort of help them with debt, which they've been struggling with for a while. And I think analysts have flagged as a concern. And, there was a bit of reluctance, Simon.
You know what I think happened? Stephen Sard, CEO of Aspen, mentioned the word deals. He said, maybe we'll go and do some deals. And I think that just spooked the market. Because if we step back a bit, Aspen has always done big deals and small deals, but they've always done deals, and has ultimately always paid for themselves. In Japan, which they sold at a significant, a couple €100 million profit. The Thrombosis deal, again, they made a profit, and they still get to manufacture and for developed markets, and they get to manufacture and distribute for emerging markets. So that deal takes another 12 odd billion off their debt, takes their debt down to about 25 billion. When it peaked, the debt was around 54 billion, and that was too much debt. They were in breach of debt covenants, and it spooked the market, and understandably so. Absolutely, that was the correct response to it. I got to say, I mean, I appreciate the concern around deal making, but Stephen Sard, he's proved himself that even when he does a bad deal, he can at least eke out some sort of profit. It might not be a knock it out the park. He's got significant manufacturing capability that he's built up over the last 20 years, FDA approved capability, so that's which comes in at 14 Rand 50. So, it's either on a PE of around 10 or 8 times. To my mind, both of those are cheap. A drug manufacturer such as Aspen, with its positioning in emerging markets and its strong cash flow, I think is easily worthy of a price earnings closer to 15 times. So I mean, I think Aspen is actually looking like a really good steal at this point. As you say, the market is not convinced. They've sold it down after that initial pop on the news of the deal. And then the results, they sold even more aggressively. But I really think that was Stephen Sard in the results presentation saying, yeah, maybe we'll go and do some deals. And this is the core DNA of Aspen. I mean, deals always bring risk. I like that they don't issue share, so the risk is just balance sheet risk. It's not going to dilute me in any sense. And with respect, Stephen Sard has proved himself to be a top deal maker, are the best two in themselves. A little bit
Thanks, Simon. Refining or restructuring or redesigning their strategy. I don't even know what you want to call it. And they have a CEO leader being
because the pioneer, basically Zeder was just a strategy, certainly as I understood it, was less about having minority stakes in agri assets. And by agri assets, we're not talking about the actual anything, but I've certainly put Zeder on a pure agricultural play in South Africa there. But I put it on today's show notes just because I think it's worth keeping an eye on. It's worth watching and seeing what that strategy is and how it unfolds.
Yeah. And as you know, we've already discussed, it is about who takes the reins, how do they move the business forward, and what does that new leadership structure look like going forward. And then lastly, as you pointed out, maize, the price of maize.
It's called locust plagues, with a degree also in what it's done is it's created a imbalance globally. So that and around a little bit spooky levels. Wheat as well, but bread being the biggest one there. But that'll have a knock-on onto your Tiger Brands, your AVI to a much lesser degree. And I was going to say Pioneer, but of course Astral. They issued it that Astral is... SR restaurants, quick service restaurants, been to those sales, 2,400 pain here. And again, keep an eye on Astral because they're a solid operation. At some point, the maize price will reverse and start coming down a bit. That helps them, and that will significantly boost their margins. But at this point in time, it is hurting. And the weird part is, the maize price is sort of almost back at the levels. Quantum a lot less because they're predominantly an egg layer, and where they do broilers, they sell those broilers to Astral, and they do basically a cost plus, as I understand that contract. So the impact here really is going to be, to a degree,
thanks, Simon,
from the generation of.
Yes, and just actually a point on that. It would be a great one, and I think lastly, to sign off, a lot of Austrians have been very lucky, having received stimulus checks from the U.S. government. U.S. Austrians, a few.
It's two things. Firstly, what is.
But yeah, so thank you very much, Simon, and thank you to everyone for joining us. And we will chat to you. We're not around next week because we're on holiday.
Is it next week?
The two.
Yeah.
No, it's the week off.
Is it the week off?